Hi, welcome to Forex in 4. I'm Mike Conlon for FXEDU, and in the next 4 minutes, I'm going to show you the highlights of where the action is in today's Forex market. So let's get started.
Good morning. Today is Wednesday, October 6, 2010. This morning we're talking about fairly bad or very bad. And the reason we're using those two adjectives there for the word, or I guess they're adverbs for the word bad, because that's what Goldman Sachs came out and said their outlook was for the U.S. economy for the next 6 to 9 months. So they said it's either going to be fairly bad or very bad. Well, that's not too encouraging to the markets when they hear this kind of thing. But anytime I hear something out of Goldman Sachs, the conspiracy theorist in me always says, well, you know what, they probably just loaded up on safe haven assets, bought them cheap, now they're trying to get everybody to buy them from them so that they can make some money. But, this time I think it may be a little bit different. And I discussed this briefly yesterday, but we've got a lot going on around the globe as far as central banks are concerned and the potential for further quantitative easing. So we're really seeing a disconnect here, especially here in the U.S. between Wall Street and Main Street. And some of the differences we can see can be highlighted by what we saw this morning in this morning's action with the ADP jobs report. Now, this jobs report came in worse than expected. All right, so initially the market sold off, and I just want to show you here. Let's look at the euro on the 5-minute chart. Initially, the market sold off on the news. All right. Where was it? Right there, okay, about 8:30. But then it reversed and came back to a little bit of risk taking. And the logic was this: is that at first it said, "Well, jobs report's bad, so that's gonna be bad for the economy." But what that does is that everyone says, "Well, wait a second. That means that the Fed's going to actually maybe go ahead with the quantitative easing, which is good for the market." So as you can see, what's good for the market is not necessarily what's good for Main Street, and that's one of the huge problems we're having here in this country and with this U.S. economy. Now, this report comes 2 days in advance of the non-farm payrolls report, which is the granddaddy of them all, the big report on employment, and that's really going to let us know where we stand as far as private sector job growth goes. So, as we're looking at the euro, you can see it started off the morning lower. All right, sold off a little bit. Fitch downgraded Ireland's debt rating 1 notch to A+. So they're coming out with their rate policy meeting tomorrow. This could encourage them to come out with more of a dovish stance going forward. Now, they're not expected to do anything with rates tomorrow, but if they come out with this dovish stance, that could be a little bit euro negative. You can see that we came up close to that 139 figure that identified yesterday as a 61.8 retracement level on Fibonacci support and resistance. So that's what's happening with the euro. But some other areas we're seeing some strength. I just want to look at the Aussie. Aussie, let's go to the dailies on this. You can see the Aussies at got 3-month highs right now. I think this goes back even we might be close to 2-year highs here. 1 year. Let's go back to 2 years. Yep, we've eclipsed 2-year highs, so we're up there on the Aussie. You can see pound. Pound is coming back towards. Let me see here. Let's move this around to 3 months. Pound is coming back towards a 3-month high here. You can see just some resistance at 160. All right, they're weaker this morning. You can see here across the board because they've got their rate policy meeting tomorrow, and there's speculation that they may return to the quantitative easing as well that policymaker Posen called for last week. So that's given investors a bit of pause here with the pound. But if they don't resume quantitative easing, then I think we could see above 160 in no time. Just wanted to show you the loonie as well. Okay, loonie here is back to 3-month highs. You can see it's right at 101. Wow, just over a penny away from parity, basically, versus dollar. And as you can see, all of this is based on U.S. dollar weakness. I mean, I'm starting to feel like a little bit of a broken record here when I talk about dollar weakness, but you can see that the yen actually got lower as well, lower below to pre-intervention levels, and this is actually a new 15-year high for the yen, while this USD yen pair is lower. All right, so we've got dollar weakness basically driving markets. Okay. And much of the recent jubilance we've had in the markets has been a result of the prospect of further quantitative easing from the Fed. But recently, Japan, just yesterday and the day before, they announced that they were going to quantitative ease further. Right now, the UK is talking about it. That's sort of got people worried about the pound a little bit. And then, if of course we do that here in the US, we've got all this quantitative easing going on. That's supposed to flood the market with cheap money. Hopefully, scare off deflation and encourage a little bit of inflation. Well, maybe the market's going to see that as, hey, that's a bad thing for the global recovery and global economies, and that could be the driver that actually, starts to see a little bit of dollar strength. Because, right now, I got to tell you, I don't see all this quantitative easing as a good thing because, these economies are not ready to recover at this point, and additional Fed, central bank, and government assistance, isn't going to allow these things to stand on their own 2 feet. So, that's my personal opinion. Of course, as a trader, if this is what the Fed's going to do, and the market seems to like it, well, hey, I'm going to go along with it too, because the old adage, you never want to fight the Fed. But that's the only scenario right now that I could see for possible dollar strength. Either that, or maybe we get just awesome non-farm payroll numbers on Friday, which cause people to think, hey, maybe we're not going to get quantitative easing. But at the end of the day, we're in a very precarious position right here. We have a lot of dollars at 2-year lows to a lot of these currencies out there, and if everybody starts to quantitative ease, it could bring up structural problems. Who knows what can happen at that point? So if we do start to see further rounds of quantitative easing, I expect to see gold continue to go on a tear. Gold's at 1340 this morning, all-time highs. All right, I've actually got the old gold chains that I haven't worn in years lined up, and I'm ready to sprint out the door as soon as gold hits 1500. And if all these guys start doing a little bit of quantitative easing, I could see that happening real soon. So, while everybody's real happy about the way the market's been moving as of late, including these cheerleaders on economic television, I got to tell you that I'm not having such a rosy outlook myself, and I'm preparing to see what happens if the economic outlook does not improve, and if some of these things start to happen. So that's what I'm looking at today. I'm starting to trade cautiously as we reach these new highs and new lows, because there's always increased volatility around these levels. So I would suggest that perhaps you do the same. So that's what I've got for today. Good trading to all.
As always, be sure to check out the written blog at www.fxedu.com to get complete coverage of today's Forex market. If you would like to learn more about how to trade the Forex market from professionals like myself, be sure to check out our affordable Forex trading courses. And if you're already a seasoned professional or aspire to be one, ask us how we can help you achieve your Forex goals. Go to www.fxedu.com to get started today.